Mr. Too Late. Is Trump correct in calling out the US Fed Chair? Hi everyone and welcome to Ainslie Insights, brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Be sure to have a look. Today, welcome back Drew, who's been exploring this issue. Is the Fed Chair too late? Is Trump right on that? Is it more just noise? How does it all fit together? How are you going today, Drew?
Good, Chris. It's been a while. Good to see you again.
It's great to see you. I've been very curious on your perspective on some of this that's been going on. I mean, we seem to get new headlines all the time. You've been warning us for a while now that that's what happens during this phase of the cycles where we are. We get a lot of noise. But let's dig in specifically on this one. What's going on here? What's the rationale behind the president saying, Jerome Powell, you're too late? Is there merit to that?
Yeah, it's a really interesting dynamic at play at the moment. So Trump's obviously pushing for looser monetary policy, so a bit of monetary easing from the central bank in America, and he thinks they're overly restrictive. Now, many will agree with that. If you look just at surface level data, you can see inflation's coming down, unemployment is going up, and if the Fed's official mandate is to balance inflation and unemployment, they're certainly at a point now, given that they're so, in their own words, data dependent, that they have enough data to lean on to warrant a significant pivot from being restrictive to easing on monetary policy. Now, they have been reducing the levels of quantitative tightening, and just like any trend, the intensity reduces and reduces before it flattens and turns the other way. So they are moving in that direction, but Trump's been very vocal about calling Jerome Powell, Mr. Too Late. He's calling him a total loser. So there's a little bit of high school drama unfolding in the American financial system. But what's interesting is that he's specifically asking Jerome Powell to cut interest rates. So it's not, he's not calling for open market operations or any other type of quantitative easing, but he's specifically talking about lowering interest rates. And there is an argument to be made that the Fed knows exactly what they're doing, and lowering interest rates might actually cause more problems than solutions. And there might be other ways for the economic stimulus to come about that the Fed's probably already working on bringing about. So, the problem with lowering interest rates, firstly, is that it would affect the short end of the yield curve. So reducing interest rates would probably bring down the yield on the, sort of 3-month shorter dated government securities. If the yield on the 3 months start dropping and the yield on the 10-year, for example, are still high and even increasing, that yield curve will start accelerating to the upside. And we really need to see a flattening of the yield curve. We want stability in the bond market. We don't want too much of that yield spread at the moment. So lowering interest rates arguably is not really going to help, stabilize the bond markets. It might actually cause more problems in the short term. That being said, there's plenty of things they can do to ease monetary conditions. So, they could actually just buy long dated government debt. So if they bought a bunch of 10-year bonds, that would increase the demand and so the collateral value, and that would bring down the yield on the 10-year bonds. That would help stabilize the yield curve while also injecting liquidity. And if they wanted to temper that, they could, in addition to that, actually maybe sell some of the short dated bonds. So that would further flatten the yield curve by increasing the yield on the shorter dated ones, by increasing supply and tempering the amount of liquidity injected by the purchasing of the longer dated ones. But really, I think, with the FOMC coming up tomorrow, I don't think we're going to get a rate cut. The market's more or less priced that in. But I think what's really important is keeping an eye on the sort of forward guidance, the rhetoric in the press conference. That is a, really, I think, understated tool that the Fed can use to stabilize markets, to build confidence, and to sort of bring about almost economic, stimulation by people looking forward to what the Fed's going to do and planning accordingly. So I think between the forward guidance and some open market operations, which the Fed is probably looking at already, they'll get the economic stimulation that Trump's after. But I don't think they're necessarily going to be cutting rates. And I think him putting that much outspoken pressure on them to do that is actually putting them in an awkward position where if they, let's say it was even the right thing for them to do, it will look like the president has influence on the central banks and their decisions. And they need to maintain at least that image, if nothing else, at least the image of autonomy and independence from political pressure to maintain, confidence in the fact that central bank intervention is the right thing for market stability. And it's not just based on the whim of whoever the president is at that time. So there's a lot of different things at play, but quite an interesting landscape to see what happens at the FOMC tomorrow.
Look, I could spend hours just unpacking just everything you've said there. There's so much at play here, so many moving parts. One thing in particular that stuck out to me is the confidence. We know confidence is so important to the entire point of the Fed, right? Like the whole point there is that they are the last resort. They're the people, the smartest guys in the room that are standing there to backstop the economy and make all of this fix, like make it all work. So that is problematic when you have them pushed into a corner where they have to act one way or the other anyway. But the other thing that's interesting from what you were saying, from what I've observed recently, is I think they are doing exactly what you just described. They're using some of those tools. There's been some talk on X about 3-year bonds that were issued, and then they were simultaneously buying some, which is quantitative easing in one form or another. They might be using different techniques to what they've used in the past, but they are on the ball there, and they are doing other things, and cutting rates to exactly to your point might not be the best solution here, particularly against a backdrop of tariffs. And I think that's one that I keep getting stuck on, going, well, we know there's inflation, even if it is just short term, even if it is just one-off spike in prices. If tariffs are added on to costs, you by definition are going to see a rising cost. So it wouldn't be surprising to see that flow through to inflation. And then if you're the Fed, your job is to keep inflation down. So, lowering rates just before you can see a very clear impulse of inflation coming doesn't seem like the right thing to do. So some of those other techniques probably are the correct thing to do. It's very complicated.
Yeah, it's amazing how much of this is also about maintaining face, because does the Fed really care that much if inflation comes back, or do they just want to make sure that they're not the ones who are blamed for it? Like, are they really going to lose sleep if everyone's annoyed about inflation but is blaming it solely on the president and saying that the Fed has done everything that they could do? And that's why I think, everyone's focusing on interest rate cuts and focusing on something that is labeled as QE officially. But I really doubt that the Fed's going to come out and start, screaming from the rooftops that, hey, it's time for quantitative easing and we're cutting interest rates, because the inflation that is going to come about, like you said, because of tariffs and a whole host of other reasons, is baked into the cake at this point. I really am quite confident that we're going to have another bout of inflation, towards the end of this liquidity cycle. Now, of course, that's yet to be seen, but it really looks like all the pieces are in place for that. So they need to be, I think, really careful on how they speak and what policies they make moving forward to make sure that they balance the economic activity or stimulation in a way that doesn't look like they have played a part in this inflation coming about. Because, the memes of Jerome Powell with the money printer around COVID time, everyone knows who caused inflation this time about, with the COVID era stimulus that took place. And so we have cracks in the system. We have unemployment moving up. We've got commercial mortgage-backed security delinquencies at an all-time high, credit card defaults at, almost at an all-time high, and the cracks are really starting to show. And so they are going to have to loosen monetary policy in some shape or form, but they're also going to have to do it in a way that isn't overt, and it's almost covert easing that will allow for the economy to stabilize and even, boom. But when inflation comes about, they can put their hand up and say, look, we weren't too easy with monetary policy. This is because of X, Y, and Z. and they'll be able to maintain their legacy and reputation amid what I think is going to be quite a tricky situation towards the end of this liquidity cycle, where we might actually have inflation and recession simultaneously, which is basically an impossible situation for a central bank to effectively deal with.
I just want to push a little bit on one point there about the unemployment, because the Fed does have a dual mandate here, that it is about that inflation angle that we just talked about, but also keeping unemployment under control. Now, we've seen the last unemployment data that came out was actually quite strong. So we haven't, or at least stronger than expected. So we haven't seen the real pressure yet on the unemployment side, similarly to how we haven't really seen the pressure on that inflation side yet. We sort of know it's coming, as you've highlighted. We know that's what we would expect down the track. But if it's not there yet, then is part of this maybe Trump being very well aware of that and saying, look, do it now because we know we're going to have an unemployment problem coming and we know we're going to have an inflation problem coming.
Yeah, I think that's a huge part of it. I mean, this is that sort of sweet spot. This is that opportunity that they might not get. The thing with unemployment is, yes, expectations were higher, but that number has been creeping up quite steadily for a while now, with steady higher highs and higher lows on the unemployment chart. And there have been plenty of recessions that started with unemployment at the levels at which they are right now. And what happens is it accelerates basically as a vertical line to the upside from what I've seen. So, it's not so much that, unemployment's really high, now we start paying attention, because at that point it's usually too late. It creeps up slow and steady and then just shoots straight up. So unemployment being at the level at which it is right now, absolutely that steady higher high and higher low trend could roll over, could chop around sideways for a while. It doesn't necessarily have to accelerate at this point. And so a little bit of economic stimulation right now would be the right thing from that perspective. And in terms of inflation, yeah, true inflation is down at like 1.45. So this is the time for them to really covertly stimulate. I think that's what Trump wants. He is obviously, interested in a booming economy under his presidency. And so he knows that if they don't do it now, it's going to be a lot more difficult for them to make that decision a few months down the track. So he's almost nervously pushing for them to ease. And look, I think they will. And I think everyone's going to come to the same page. But at the end of the day, the thing to really pay attention to is the bond market, the yield curve, the spreads between, a lot of people look at the 10-year, 2-year, but I think the 10-year, 3-month is a little bit more, is a little bit sharper to keep an eye on. And the spreads look okay at the moment, but yeah, if they start cutting interest rates quite aggressively now, I really think that 10-year, 3-month yield curve will spike to the upside. And, there's enough people looking at that to know what comes next if they do that. So it's going to be a delicate situation. I think they're good at what they do. They know how to do it. So I'm not too concerned. I'm quite sure they will, do things in an appropriate way. But all roads, I think, lead to a pretty challenging couple of years later this decade. In the meantime, though, look, we might just be setting up for a risk-on environment in the short to medium term.
I just have one final question to wrap this up. If someone's watching this and they don't really understand how to monitor bonds, I know I didn't for a long time. Bonds are tricky. We tend to talk a lot about the MOVE index as a probably even better way to look at it. Like people say tens and twos and yield curves, and I know a lot of people's eyes glaze over when they hear that, and not because they don't like the concept, they just find it a little bit too challenging to actually see. The MOVE index is something you can look up that actually seems to show pretty clearly what's going on just in terms of volatility. Can you just wrap this up with a really practical guide for people if they just want to get a little bit more understanding about what you've been talking about with bonds, how they could do that through looking at the MOVE index?
Yeah, the MOVE index is just tracking the volatility in the bond market essentially overall in aggregate. So when you see spikes, and this is really interesting, when you see a spike in the MOVE index, usually around that 140 level, it's always been followed by central bank intervention. So, they're coming in to stabilize the bond markets. Really, you can see stock markets crash, you can see sentiment crash, and it doesn't necessarily mean that you're going to get intervention whether that's change in policy from a president or central bank intervention. But when you see that move index and you see volatility and instability in the bond markets, everyone comes to the party, everyone's suddenly getting along, and everyone's got a common objective about saving the bond market. So um, yeah, an increase in the move index usually means volatility is increased in the bond market, tends to coincide with global liquidity going down, and tends to be a risk-off environment. Lower volatility in the bond market usually just means more stability. People have more room for speculation, and there's more liquidity in the global financial system. So yeah, tracking spreads is probably a little bit more cumbersome. Keeping an eye on the move index is an interesting way just to know when there's instability, when to go risk on, when to go risk off, when to expect central bank intervention. And I think like clockwork, we'll see what happens tomorrow. I don't think we'll get rate cuts, but like I said in that rhetoric in the press conference after, I think we're going to see a little bit more of a dovish stance. And I don't think there's any coincidence with that coinciding with a move index. I think it hit about 138 or 139, so basically 140.
Pretty much spot on with those numbers, yeah. Look, absolutely fantastic as usual, Drew. Really appreciate you digging into all that. I think that's really useful advice for people who find it a little bit over their head, but go, okay, that's something I can look at. I can go look at that chart. It's pretty straightforward to look at. When it's spiking up, we've got a problem, and that's when you can really be looking for that intervention. So very useful as always. So thank you for that.
Thanks so much, Chris. Always good to chat to you, and we'll speak soon.
Absolutely. Thanks everyone for watching. We'll chat again soon.